Capital gains tax is an important concept for anyone who invests in stocks, real estate, or other assets. When you sell an investment for more than what you paid for it, you make a profit. That profit is called a capital gain, and the government taxes this gain just like other forms of income. Understanding how capital gains tax works helps you plan your investments better and avoid surprises at tax time. Capital gains represent the profit you earn when you sell an investment for more than its purchase price. For example, if you buy a stock for $1,000 and later sell it for $1,500, your capital gain is $500. This applies to various types of investments including stocks, bonds, mutual funds, real estate, and even collectibles. The key point is that you only realize a capital gain when you actually sell the asset, not while you are holding it. Calculating your capital gain is straightforward. You simply take the selling price of your investment and subtract the purchase price. The difference is your capital gain. If the result is positive, you have made a profit and will owe taxes on that gain. If the result is negative, meaning you sold for less than you paid, you have a capital loss, which can actually help reduce your overall tax burden. Capital gains are divided into two categories based on how long you held the asset before selling it. Short-term capital gains apply to assets you owned for 1 year or less. Long-term capital gains apply to assets you held for more than 1 year. This distinction is crucial because the tax rates are very different. The government rewards patient investors who hold their investments longer by offering lower tax rates on long-term gains. Short-term capital gains are taxed at your ordinary income tax rate. This is the same rate you pay on your salary, wages, or business income. Depending on your total income, this could be as low as 10% or as high as 37%. Because these rates are typically higher than long-term rates, selling investments within a year can result in significantly more taxes. This is why tax planning and timing your sales strategically can make a big difference in your after-tax returns. Long-term capital gains receive preferential tax treatment with 3 possible rates: 0%, 15%, or 20%. Which rate you pay depends on your taxable income level. Lower income earners may pay 0% tax on long-term gains, which is a significant advantage. Middle-income earners typically pay 15%, while high-income individuals pay 20%. Even at the highest rate, this is usually much lower than ordinary income tax rates, making it beneficial to hold investments for more than 1 year. Let's walk through a practical example. Imagine you bought stock for $10,000 and sold it 2 years later for $15,000. Your capital gain is $5,000. Since you held the stock for 2 years, this qualifies as a long-term capital gain. Depending on your income bracket, you would pay either 0, 15, or 20% tax on that $5,000 gain. If you are in the 15% bracket, your tax would be $750, leaving you with $4,250 in after-tax profit. Remember these essential points about capital gains tax. First, any profit you make from selling investments is considered taxable income and must be reported. Second, the length of time you hold an investment determines whether it is taxed as short-term or long-term. Finally, holding investments for more than 1 year typically results in lower tax rates, which means more money stays in your pocket. Smart tax planning around when you sell your investments can save you thousands of dollars over time.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.